Thanks for joining us now. Krishna Memani, Invesco Vice Chairman of Investments, and Lindsey Piegza, Chief Economist at Stifel. Krishna, you've been bullish. You've been long. It's been working.
Yes.
The S&P. And again, this morning, we're almost at a new high.
Thank you. I think the outlook for the markets in 2019, probably 3,100, but I think outlook for 2020 is meaningfully better because the global economy probably re-accelerates. And the reason for that is going to be the easing of financial conditions that has taken place on a global basis. While the Fed would like to have the data, I think even for the December meeting, I think they probably cut in December as well because the re-acceleration probably doesn't come out in 2019. It's really more 2020.
Has anyone noticed that if you were to look at year-over-year earnings per share growth, we are coming out of really a flat year, and the market was exactly flat for the entire year. I mean, I think it might be. It might be related. I mean, if you could figure that stuff out, you might actually be able to decide.
Market is working like relative to earnings?
Yes. Well, it really does work.
Oh.
It really does work.
A whole lot has happened.
I know. But when it all comes to, and then you're saying we accelerate next year, and earnings per share growth is expected to at least be mid to high single digits.
Exactly. So I think 2019 was the result of the Fed tightening that took place in 2018.
Well, we also had big gains. We were consolidating some huge gains the previous year from what people, either you liked the Tax Reform Act or it was a sugar high. Either way, it did result in some big earnings gains.
Oh, absolutely. And I think the future earnings growth is not going to come off of tax cuts, of course, because there's not much room to do that anymore. However, I think any acceleration in global growth can get you to that mid-single digit level rather easily. I think what to focus on this earnings season is the third quarter earnings, and that probably ends up being the bottom of the cycle, or at least bottom of the near-term cycle. The guidance is okay, not spectacular, but I think acceleration is coming.
Hey, Lindsey, we'll get back to Leisman and the report. You were probably frantically taking notes with everything Steve was saying. Did you? Is that sort of are you in the same camp? Did you hear anything new there that surprised you, or we look for one more cut and then a pause?
No, I do think the Fed will continue to ease as we see this further loss of momentum in the data. As Steve pointed out, it's very likely that we continue to see a further slowdown in hiring. Manufacturing remain in contractionary territory. Business investment has been very weak, and we've seen early indications that the consumer is now tightening their purse strings. So taken together, this not only justifies an October rate cut, but I think the Fed is going to be increasingly concerned about even being able to maintain this lower level of more moderate momentum going into the end of the year, and concerned about when we turn the corner into 2020, if in fact we do see that loss of momentum continue, the risk of the R word, recession, begins to become a real concern. And in fact, we saw that in the meeting minutes from last month. A number of Fed officials increasingly concerned about being able to maintain this positive expansion, and in fact, a number pointing out the rising risk of recession. So I think the Fed absolutely cuts in October, cuts again in December, and if we're not able to stabilize, further cuts are very much warranted in 2020.
I think the Fed looks at this more like one of those meals where you wait a little while for the meal to come and you fill up on bread, and then you go ahead and eat your dinner, and then you feel a little bit sick afterwards. And I think that's overstating the case here. But the idea is, I think the Fed believes it has a lot of stimulus in train. And I don't think it's averse to cutting more. What I do think is it wants to see what it hath wrought before it goes ahead and either commits. And I think December is a possibility of a pause until we figure out how much weaker it goes. Lindsey, I don't know.
But isn't this all about language?
It's all language. It's all language. Language equates to billions and trillions of dollars worth of movement of instruments all over the world.
Well, I think it is about language, but I think they already have a whole bunch of things in motion. So the non-quantitative easing, quantitative easing that is taking place in the marketplace is actually quite significant. If they are going to add $80 billion or $60 billion a month to their balance sheet, I think that is significant. The Fed is playing it really smart. They are not boxing themselves in the way they did in fourth quarter of last year by talking all nonsense that we will continue to tighten. I think having done all the things that they have done, the smart thing for them to do is to continue to watch.
That's sort of the Fed's attitude, is that the reversal from the expected tightening was a piece of the easing. The change in the balance sheet, another piece of the easing. The cut in interest rates, another piece of the easing. So it feels like there's three different trains of stimulus that have been set on their journey, and it takes time, they think, for it to. And I think that what's interesting is it sees the market, at least for the moment, comfortable with that. And if it can take a pause, I think it's going to take it.
I think that is true. However, I think given what they did in 2018 and the significant slowdown that it wrought on the global economy, it would be prudent for them.
They're going to go.
I think they're going to do it.
Can we get one more comment from Lindsey, who we should have?
I know.
It was my bad.
Yep, Lindsey.
Well, I think at this point, the Fed has recognized that policy went well beyond neutral as they tightened very aggressively in 2018. So July, September, those rate cuts just get us back closer to neutral. We're not yet in accommodative territory. So the Fed still is very concerned that they need to get ahead of this weakness. They don't want to continue to chase the economy down, particularly given that we're starting from such extremely low levels of rates. They don't have the ammunition in their tool belt to slow play this. They need to be aggressive. They need to get out ahead of the weakness. And that's why I don't think they're going to have the opportunity to pause in December. They need to continue to lower rates until we see the data stabilize.
We're going to have to end it there. I'm trying to figure out who to listen. Everybody on the Fed, there's such a disparity of opinion. I need one person who talks for everyone.
Well, don't listen to the Fed.
I don't know if it's Powell. Is it Powell? And I don't know what he thinks. Is it Clarida? Who is it? We got to go.
Don't listen to the Fed. Pay attention to the credit markets. If there is an impending recession, you will see significant widening there, and there's no sign of that.